This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hi, welcome to the monthly bonus episode of the AJ Bell Money Markets podcast on all things to do with investment trusts. I'm Dan Coatsworth and joining me is Tom Sieber. Hi there, Tom.
Hi, Dan. Yep, we've got a big private equity theme running through this episode of the podcast, hopefully lifting a lid on how these types of investor operate.
Yeah, that's right. First up, we're going to have an interview with Stephen Tredget from Oakley Capital Investments about how this investment trust taps into private equity funds in search of growth. We're also going to hear from Ken Wotton from Strategic Equity Capital about how he uses private equity style methods to invest in public markets.
One of the most popular investment trusts with the general public has just published its financial results and it's significantly beaten the market. Stay tuned to find out which trust this is and how well it's done.
Now, later on the podcast, I'll be talking to Emma Bird from Winterflood on why investment trusts are popular with people looking to generate an income from their ISA or pension. We'll also hear from Shares Magazine's Steve Frazer and Ian Conway about Monk's Investment Trust, perhaps a lesser known or lesser understood trust from the asset manager Baillie Gifford. First up, let's kick things off with a look at the latest results from one of the hot trusts on the market now.
That's right. We're talking about JPMorgan Global Growth Income, or if that's too much of a mouthful, a lot of people like to call it JGGI. So, Dan, could you tell us a little bit about these bumper results that the trust has just come out with?
Yeah, so I mean, we've done a bit of a sort of a deep dive on the JPMorgan Global Growth and Income Trust on a previous episode of this investment trust podcast, but I thought it was worth coming back to this trust because its annual results to the 30th of June showed total return from a net asset value, so the underlying value of its portfolio, of 28%. And that's really good, particularly when you compare it to sort of it's something called the MSCI All Countries World Index. It's a bit of a mouthful. Essentially, that's like one of the main benchmarks for the global stock market. That returned just over 20%. So you're looking at about an 8% extra return from investing in the JP Morgan product. So this is all in sterling terms. So this is, I think if any investor was making 28% return on their investments year in, year out, we'd all be incredibly happy. This is sort of levels that you shouldn't expect to make. I mean, when you get them, they're fantastic. But
it's a bonus, isn't it?
Yeah, definitely. I mean, I think what's really interesting here is that it's someone who's thinking, okay, well, this trust invests in companies around the world. So is it obviously in all the big sort of tech ones that have been doing really well? Well, there's a group called the Magnificent Seven. You might have heard of it. It's names like Amazon, Alphabet, Tesla, Microsoft, Meta, Nvidia. So it's got four of these names in its portfolio, which are Amazon, Meta, Microsoft, and Nvidia. It doesn't have all the others, so it's not simply relying on the big giant names that are have been driving markets for a while. It also has stakes in other companies such as transportation group Uber, the drugs company Novo Nordisk, and the insurance company Progressive. So it's essentially a bit like Scottish Mortgage in that it tries to back sort of high growth companies, but it also has this sort of income element as well. So you are getting good dividends from it. It's on a yield just over 4%, so it's got good dividend growth. But what I found is interesting when you're reading the results is like, obviously it's backing these big companies, but it's slightly worried about the future. It's going a lot more into sort of more defensive areas. So whilst that sort of slightly held back performance in the last few months versus the market, it's interesting to see where it goes next, because the manager seems to be really cautious about the near-term economic outlook. They're sort of indicating that they're sort of seeing some early warning signs of sort of a US recession. So I think that rather than sort of look at sort of cyclical parts of the economy like US banks, what they're doing is that they're looking at areas like the financial sector, but they're going for high quality sort of payment companies instead. So so I mean, overall, it's been very good performance here. You can understand why more and more investors seem to be talking about it, particularly retail investors, so the general public. Lots more people sort of gravitating towards it. Of course, that does put a lot more pressure on the trust to keep delivering. But judging by those last set of results, certainly seems to be doing well at the moment.
Yeah, it's interesting. You do trusts and funds kind of, they wax and wane in terms of popularity, don't they, a bit? And it'll be interesting to see if JGGI can sort of sustain this over time. But to have outperformed the market in itself is quite difficult, given some of those big companies you mentioned have done so well that outperforming is quite a feat, really, isn't it? So it is notable that it's managed to chalk that up over kind of a relatively short period.
Yeah, I guess a bit of just a disclosure. I hold money in it personally in my pension, but I'm actually quite relatively new to being an investor in it. But yeah, I certainly it seems to be doing the job well at the moment, and particularly when people are sort of questioning, has all the good times over for sort of these sort of high growth areas of the market. So I'd certainly be watching it with interest, particularly now it's going a little bit more defensive.
Yeah, there's some balance there, isn't there, I guess?
Yeah, definitely. I think that's what investors certainly increasingly looking for. They are looking for that balance. They're not looking to sort of go all in sort of high risk sort of stuff. But at the start of the show, we promised you a special about private equity. So we thought, why not talk to two different managers who access sort of the broader private equity theme through investment trusts. So let's kick things off with our first interview. Tom recently caught up with Stephen Tredget from Oakley Capital Investments, which invests in funds that are managed by the private equity group Oakley Capital.
Hi, Stephen. So thanks for taking the time out to speak to the podcast. I wonder, could you give me a bit of a picture of the strategy behind the trust and what you're trying to achieve?
Yeah, of course. And thank you, Tom, for having me on the podcast. So the trust, Oakley Capital Investments, or as we refer to it, OCI, invests solely in Oakley Capital funds. So it's a direct PE investment trust as opposed to a fund of funds. And it's kind of delivered 20% compound shareholder return over the last 5 years. And it's done that entirely through capital growth, the growth of the NAV per share. And then Oakley Capital, the manager of the Oakley funds, it's a private equity manager, first and foremost. It takes majority controlling stakes in fast-growing, small to medium-sized European countries. And I guess a typical Oakley deal will have one of 5 characteristics. So, hopefully all 5. It will be one of 4 focus sectors. They are tech, education, digital consumer, and business services. Those companies will be founder-led. So 3/4 of the deals we've done, we are acquiring a stake from a first-generation founder who is allowing an institutional investor into their equity structure for the first time. And so what they have to remain invested, so they're aligned with us on the equity basis. The other thing to note is if you're making that kind of investment they're rolling in, they're much more interested in the partner that they're going to invest alongside them. And the experience, the qualities, the value add that they can bring, as much as they are necessarily about the price and value maximization.
Yeah,
and if you are the first-time investor, there's naturally a whole bunch of complexity. We might be building accounts for the first time. There might be messy shareholder structures. And we like a bit of that complexity to navigate. There should be, hopefully, heaps of opportunity to professionalize these companies. We're going to take these businesses on the kind of operational maturity journey so that after 4 years of working with us, they are more ready to be owned by larger private equity or bought by a strategic. And then the other 3 kind of characteristics are, we're going to expect this business to be kind of digitally disruptive. Have an online solution maybe that is going to take share from traditional in-person services, let's say.
Sure.
And then on that theme, there's probably going to be one of a few mega trends that we're going to be trying to invest behind. The business shift to cloud solutions, consumer shift to online, the kind of global growing demand for accessible education. And then finally, which should, be key to private equity investment in that kind of small to mid market, is that there should be an opportunity to also create value. Can we impact the outcome regardless of economic macro environment? Can we deliver something here through M&A, internationalization, introduction of more talent, digitization? You kind of get the picture. And every investment we make, we underwrite a relative base case investment thesis that we're going to make 2.5 times our money gross. Historically, we've realized 4.5 times on all our investments, but and we assume we go in and we're achieving that in a kind of modest economic early 90s style recession. And we're also going to assume that there's going to be very little, if any, multiple uplift. So if we pay 10 times, we assume we're going to have to sell it at 10 times, for example.
Right. So pretty conservative in that sense.
Exactly.
Do you build in a kind of failure rate as well? Because obviously being that primary investor, being that first investor on the scene and kind of helping to professionalize a business, I can imagine there might be times when that doesn't work out, even if it is relatively infrequent.
We don't assume a failure rate. I think there's the two things to kind of know there. One is these are quite, these established profitable businesses. So we're less talking about, kind of venture growth, or there are two tiny strategies that cover that. 90% of the OCI NAV is in companies that range from EVs from a few hundred million up to $1 billion plus. And they're established, fast growing, on average growing their EBITDA at, kind of 20% odd. In terms of over our history, we've made 58 investments. We've realized about 24, 25 of those. We've never struck out on an investment.
No.
We've had 4 investments that haven't met our investment target.
Right.
Meaningfully, like most of it, two times the money or above. Only a couple haven't returned our initial investments, and they were all made relatively early on in our history. So we're on fund 6. We're about to launch. We've just launched at the moment. That was in fund 1 when naturally we were kind of finding our feet. What was going to be our strategy in those early ones? We took on loss-making businesses, or we tried strategic turnarounds, and we learnt our lesson the hard way.
Yeah, I mean, that sort of comes to another question then, I suppose, of how the strategy's evolved. And you kind of covered that. I guess it is, you've refined it in the sense that you've perhaps things that you won't do now. Is it as much about that?
Yeah, there is the list I've given you of what we will do. The reverse of those is what we won't do. We look to find that founder that we're going to, our already successful founder, that we can help them on the journey they've already started. We don't want to kind of change direction. I guess there's been a kind of gradual evolution. It's around our focus sectors and our geographies over time. Kind of, you might do a really exciting deal in, let's say, in a private schools business, and you then look at subsectors associated with that. So you might kind of stretch your education focus, or for example, we expanded into business services in the last 2 years. And that actually kind of came out of our tech investing. We started investing in data platforms. So, for example, we invested in a company called VLEX, which provides legal data services globally. You add a number of those, and you realize, well, hang on a minute, this is probably its own sector in its own right. Alongside them, we also invested in kind of services, mission critical services, which are kind of regulation led, and kind of sell into a diverse range of industries, so testing, inspection, car repair, life sciences. So that's kind of emerged. We are unashamedly opportunity led. And conversely, if software deals become too big, too expensive. We've got no right to win. They're no longer founder-led. That's fine. We won't do a deal in software. And if, the UK becomes too expensive, there's too much competition, for 5 years, we didn't do a deal in the UK. And that's just fine for us. That we want to remain quite entrepreneurial about how we, kind of find opportunities. And I guess the other thing is around the countries we're in. We did start in the UK and Germany. And then what we learned in those, areas, while new, let's say, digital solutions were kind of penetrating there, then those markets mature. And then we've been able to replicate that in our market. So take an example, in Germany, we invested in a business called Verivox, price comparison website, essentially. We watched the kind of penetration of that solution in Germany, made 15 times our money. Then we were able to invest in alongside a similar business in Italy, a business called Facile. We invested in that company 10 years ago. And essentially, again, it's a price comparison website. It was initially just in the vertical of insurance. And incredibly, all Italians have only done somewhere in the region of 40 to 50% of e-commerce, any kind of e-commerce. Take a vertical like car insurance, even after 10 years of being in this market. I mean, we're talking about 15, 17% of all car insurance in Italy is arranged online. Compare that to the UK, where it's more like 80 to 90%. And so we're not going to take a bet on the Italian consumer, the Italian economy. We are going to take a bet that there's going to be a steady penetration of a digital solution as a result of, kind of the uptake of online penetration within the region. And that's steady. We've added other verticals, as you might imagine, utilities, broadband, etc., other forms of insurance. But that shift doesn't sound like rocket science. That shift has allowed, has led that business to grow its earnings 20% compound every year for 10 years.
Yeah. No, that makes sense. And I mean, that brings us on to another question, I suppose, about how kind of attractive the pipeline continues to look and how large a sort of pool of opportunities you have.
Yeah, I mean, I'm going to say it's the biggest pool of opportunities we've ever had, and well, it should be. We're bigger than we've ever been. We have a team of 60 investment professionals. We have an origination platform here, which has tried to kind of codify the way in which we've been able to attract businesses. We reviewed 1,500 opportunities in the first half of the year. We probably did outside in due diligence on 200 of those. And, we probably spent more meaningful time and money on 30 odd of those. And we'd have probably taken, 3 of those through to investment. That gives you the sense of the kind of scale of it, and the opportunity. And it is a kind of, particularly in that enterprise value, 100 to 500 million, there is activity in that space. Why? Because if you're looking to grow, probably what are your options? Debt's expensive and liquidity has been missing. IPO market certainly isn't reliably available to anyone. Equity backing is probably one of the few ways. And in the meantime, there's heaps of dislocation in your market. So if you're a founder, you're looking to grow, there's potentially a whole bunch of struggling peers. You're like, right, now's my moment. So the kind of backdrop has helped it. The sources of funding has helped it. Our network has kind of grown. We've also kind of, over years of consistency, forged this reputation of being the choice of founders. We were founded by an entrepreneur with a very clear vision to create the perfect backup for founders. And that's now leading our reputation to walk into the room before us now. Founders are coming to us, advisors are bringing founders to us in a way that kind of historically we probably had to go out there and kind of find them ourselves.
The trust itself obviously trades at a pretty big discount. I mean, that, you've got that in common, I guess, with a lot of other private equity trusts. But I just wonder if you got a take on that and perhaps how you look to manage that, if at all.
Yeah, I mean, I'm sure you could have an entire podcast based upon discounts of investment trusts. And so I don't know if I'm going to give you any revelations. I think the first thing to say is that there are this isn't just common to listed PE, it's common to all investment. It's not even just common to investment trusts, it's common to small and mid-cap companies, I would argue. And it's down to a number of structural issues. There's been significant outflows from UK equities. Now we're starting to see that start to reverse this year, but it's certainly been meaningful over the last kind of couple of years. There's the general risk adjustment currently imposed on small and mid-cap shares. Then you've got investment trusts structurally, and I'm sure you've talked about it in the past, the cost disclosure regime. Yes, it's changing, but it's far from changed. And, it's just historically been just easier for IFAs to avoid investment trust, to avoid putting that additional line of cost disclosure that causes confusion and upset. Just why bother? Just don't do it, and therefore avoid this whole asset class. And then why specifically PE? I mean, it is harder to value. It is more opaque than obviously investing in a single company. Now, I think as a group, as a sector, we do more and more to try and provide that additional transparency. We're fortunate, Oakley. Where OCI has got investments in look-through investments in 32 companies. We provide a lot of detail on those companies and access to information about them, and the management, kind of come and present at the Capital Markets Day. That focus is useful to us, but ultimately, your ability to truly value the underlying businesses and take a view on their long-term value is quite hard. And analysts find that hard for obvious reasons. And so they focus on, as a community, on discounts. I'll tell you to buy this asset, not on what its NAV might be in 3 years' time, because that would take a lot of effort and may be hard to achieve. But I'm going to tell you when its discount is compared to its long-run discount. And so the talk on discounts perpetuates discounts.
That's
it kind of compounds the problem. If it starts to narrow to the long-run average, it doesn't matter that that long-run average is 20% discount. People then think, well, that's the long-run average. It's been like that for 10 years. I'll probably sell at this point. And that's a particularly big hurdle we kind of have to kind of get over.
So that was Stephen Tredget from Oakley Capital Investments.
That's right, Dan. And there are quite a few private equity investment trusts on the UK stock market. But you can also access private equity style techniques through different means, including a trust called Strategic Equity Capital. Let's bring on its fund manager, Ken Wotton, to reveal the secrets of its success.
So Ken, you're known for having a private equity approach to public markets. Now, is your investment strategy exactly the same as a private equity investor, or are there some subtle differences?
So you're absolutely right. We talk about taking a private equity approach to public markets. So there's a lot of similarities in our approach to that private equity, but we are not private equity investors when we're investing in public companies. A private equity investor would typically spend a lot of money on due diligence up front. They often take controlling stakes in companies, put people on the boards, and have investment agreements that kind of give them lots of consent rights and opportunities to sort of exert control. We don't have a lot of that, but we do take a lot of the sort of philosophy of private equity, which I guess for us means focusing on the business fundamentals of the companies that we invest in. So really thinking about, if we own the whole of this business, kind of what we'd be looking for. So looking for high quality companies that can build strategic value over the life of our investment and where we're buying at attractive prices. In terms of due diligence, we think we really sort of apply an approach which tries to focus on mitigating the downside risks of investing in companies over the long term. And whilst we're not spending millions of pounds on third-party due diligence reports, what we are doing is really focusing on the things that matter and hopefully doing a lot more work to satisfy ourselves and build conviction than a typical sort of more passive public investor would do. And then lastly, we talk about taking an actively engaged approach to our investments. So being proactively engaged with the management teams and the boards of the companies that we invest in. Whilst we might not have board seat representation, we do take our stewardship sort of obligations very seriously. We want to be engaged with the board and the management on key strategic issues. We want to be a provider of cornerstone capital for acquisitions or for other investment that they need to pay to improve the business. We want to be involved in discussions around management incentives to make sure we're aligned. And in selective situations where we have large equity stakes, we want to be in the conversation if there's a takeover situation. So we can have a negotiation over the price that's achieved, if that's the right thing to do, or indeed have an ability to stop a takeover from happening if we think it's undervaluing the business over the long term.
I mean, just on the subject of takeovers, I mean, are you sort of proactively looking for sort of takeover candidates, or actually, that just might be one thing that happens down the line, but or are you actually just looking for stuff that's mispriced, misunderstood, and might just re-rate once the market understands what the opportunity is?
Yeah, so I'd say that we are looking for characteristics which are likely over time to be valued highly by either private equity or by corporate trade buyers of businesses. Because we're focused on smaller companies, it's quite often our businesses are attractive targets for either of those groups of potential buyers. We're not buying businesses or investing in companies because we think they're going to get taken over on a short-term view. That's certainly not our model. But the financial characteristics, the strategic characteristics that we're looking for are very similar to private equity, hence our private equity approach. And so it's not surprising that many of our companies end up being takeover targets. As I was saying before, we want to be in a position where when we have very high conviction about a business, we're taking a long-term view. If we can take a big equity stake in that company, then we're in a position to either enable or to prevent a takeover, depending on whether we think it's the right thing for our investors over the long term.
So it sounds like you're almost trying to get one step ahead of private equity companies. Does that mean that you're investing in something that needs a bit of work, and then it would be attractive to a private equity company, do you think?
In some cases, yes, but in many cases, it's often just because companies are relatively small, they're not very well researched, and they're in a part of the market, UK small cap, where it's relatively inefficient, and so there just are high quality businesses where that value had not been properly recognised by the stock market yet, and perhaps hadn't yet been sort of discovered by private equity either. So that's the area of the market which we sort of specialise in. And so I guess our job and our experience and our track record has been to finding those businesses before they're kind of more widely recognised. And to your question earlier on, we're not looking just for businesses to be taken over. Ideally, we want businesses that are mispriced relative to the strategic value that they have, and that over time, by delivering on their expectations and by building the business and growing, that gets recognised by the stock market and they get re-rated. And that's the ideal scenario, that we can sort of sell into the market an attractive multiple, having made money, and can recycle rather than having the business taken out prematurely by private equity or by trade.
Well, can you give me an example of one where actually all of this has happened, that you spotted an opportunity, it was unloved by the market, and it's all worked out fine either because it's re-rated or taken over?
Yeah, so one of our larger investments currently, still, although we have been top slicing and taking profits in the very recent past, is a business called XPS Pensions. And XPS Pensions is a consultancy business that does a combination of actuarial consultancy, pensions administration, and also investment advice, all focused on the defined benefit pensions market. So that the defined benefit pensions market is sort of, on the face of it, an area which people think is probably a bit boring, and it's certainly an area which, because there are many new DB schemes in place, and a lot of them being shut down for new members, people perceive it to be a sort of area of the market which is probably in decline. But actually, there's an extremely large amount of money invested in these schemes. There's a lot of regulation that sort of accompanies that. And therefore, having an expert advisory business that can help the trustees of those pension funds navigate this environment, which is sort of constantly changing with different regulations. That's an extremely attractive area to be. It's not cyclical, but it's got a tailwind behind it in terms of the sort of growth drivers of the market. So this is an area which we spotted a long time ago. There's been a number of private equity transactions in that space for private companies, which we were aware of. And we spotted that XPS was trading at a valuation multiple that really didn't reflect the fundamental characteristics of the business and the prospects they had, the really strong market position they've got in this area, and was at a big discount to the values that private equity were prepared to pay for private sort of comparable businesses that we could see. So we built a really quite meaningful stake in the company over the last few years. We became the largest shareholder, and thankfully we sort of called that quite well. And over the last 2 years, particularly catalyzed by things like the LDI crisis in 2022, there was just a huge increase in volume of advice required in that space. And XPS, we're in a sort of prime position to be able to benefit from that. So the business has grown really strongly. It's delivered positive upgrades to market expectations over the last 2 years. And that has driven a really strong sort of performance of the share price over the last 2 years. And it's been our strongest performer as an investment over that period. As a result of that, it's become a big sort of part of the couple of our funds. And so we've taken profits in it. We still think the prospects of the company are good. Still think the valuation, albeit it's gone up a bit, is still attractive. So we're still holding on to the rest of it. But we've taken the opportunity to sell into the market. And actually, the company just got admitted to the FTSE 250 earlier on this summer, which has driven some additional demand and liquidity in the market. So we've been able to sort of top slice and sell into that demand.
What about something else in your portfolio now, which is perhaps in sort of the early part of its journey towards, potentially making you money over time?
Yeah, so one which we've been recently building a stake in is a company called Brooks Macdonald. So Brooks Macdonald is in the wealth management and advice sector, which is a sector we really like, where we think there's a lot of long-term positive drivers, particularly driven by demographics and more sort of individual control over their own wealth and investments that has been driving the sector. There's been a lot of consolidation in the sector, which is driven by economies of scale and by sort of regulation and other things that have sort of meant that being larger is better. And there's been a lot of private equity interest in the sector and a significant number of M&A transactions in the space at really quite high valuation multiples. Brooks Macdonald, it's a listed company. It's suffered from what a lot of UK smaller companies stocks have suffered from, which has been out of favour because there's been money flowing out of the UK small cap sector, and that's depressed valuations. But also, Brooks specifically has sort of faltered in terms of its own growth, and therefore has been, we think, has been somewhat unfairly judged to be by the market to be X growth, and therefore is being rated at a discount as a result of that. And so that to us is the opportunity, because we think this is a high quality business where some of the leading indicators of a return to growth in terms of net inflows to assets under management starting to become apparent, but the headline numbers are still not sort of showing that really obviously yet. So the market hasn't quite cottoned onto it. But they've just announced recently a new CEO, and she's been very proactively sort of trying to work on really honing the strategy to be a bit clearer. And that's culminated recently in the divestment of some international operations they have, which were non-core, which has really shored up the balance sheet. So this is a business which we think is about to start to demonstrate growth again. It's got a very strong balance sheet. Almost a third of the market cap is in cash. So they've got optionality to do things with that cash, which could be accretive. And the valuation multiple of the company at about 7.5 times EV/EBITDA is less than half what the typical private equity, private markets transaction multiple has been for similar businesses. So we think if the stock market doesn't start to recognise the value of Brooks and re-rate it, then it's likely to be a potential target for private equity or for a corporate consolidator.
So I guess investing in areas like pensions, business consultancy, wealth management stuff. These to the average investor, they might think that they're not very glamorous industries. Is that an advantage to you if you've got the expertise to look around these sectors, where the narrative isn't as exciting as, say, something tech related, something you can spot things because no one is looking, or actually are there plenty of big investors looking for opportunities there?
Yeah. So what we like is we like growth, but we like steady, consistent, repeatable growth, not breakneck growth, which can sort of, where businesses can falter and kind of come unstuck because they're over trading. We like profitability and we like cash generation, which often some of the sort of perceived sexier companies in the tech sector might be loss-making and burning cash, whilst they might be growing very rapidly. So what we're looking for is businesses that can grow revenue, can grow profits, can generate cash, that have strong balance sheets, that are in niche areas where there's a reason why we can get comfortable as a tailwind, and so they're not overly cyclical. And all of those things, I think, combine to create a nice balance between risk and reward. So we think the downside risks are relatively limited because they're sort of strong balance sheet businesses with which are going to grow regardless of the economy is growing strongly, and where we can build conviction that they're doing something that's different and sustainable and protected. But they are still growing. So you over a sort of 3 to 5 year holding period, which is typically what we're looking for, you get good sort of solid compounding earnings growth translating into cash generation and share price appreciation. And because we're also picking businesses we think either have underappreciated or are building strategic value, there is that optionality that if the stock market doesn't recognise it, that either private equity or corporate buyers potentially could come and drive a re-rating that way instead. So there's sort of almost 2 bites of the cherry on valuation.
That was Ken Wotton from Strategic Equity Capital with some really interesting things to say about the UK market. We've got time for a couple more segments on this podcast, starting with a chat about one of investors' favourite things, income. To explain how and when investment trusts pay out cash to investors, let's bring on Emma Bird, who is Head of Research at Winterflood.
Emma, one of the key reasons why investment trusts are popular among people in retirement is the ability to hold back some of the money that they make for investments to top up dividends in harder times. Now, hopefully that could facilitate a smooth income stream for the investor. The technical term is revenue reserves, but I'm wondering if you could possibly explain to our listeners, how does it actually work in practice?
Sure. So unlike open-ended funds, which are required to pay out all of the income that they earn during a financial year out to investors as dividends, investment trusts are able to keep up to 15% of their revenue in a financial year in revenue reserves. And these revenue reserves can be built up over time and then used to pay out as dividends in future financial years to top up the income that they've received in that year if it's insufficient to fully cover the dividend. So that's been a particularly attractive advantage of the structure in a number of periods, most recently the pandemic, when many underlying companies such as banks and oil companies were forced to cut or suspend their dividends. That led to some open-ended equity income funds reducing their dividend payouts, but many equity income investment trusts were able to utilise these revenue reserves that they'd built up in previous years to maintain their dividend or even to continue to grow it, despite potentially having seen a fall in the revenue that they'd received that year.
Some people describe revenue reserves as a pot of money, like a rainy day pot of money, but it technically is not quite true. I'm right in saying that this money is still sort of invested in the markets. It's not sitting as cash in the trust bank account. And if that's correct, what happens when the investment trust needs to dip into these reserves to top up the dividend? Does it have to actually go out and sell some investments to raise some cash?
Yes, exactly. So, the way it is often described as kind of it is a pot of cash that that the investment trust will have saved up to 15% of their income and put it away in this revenue reserves, but that's really just a kind of accounting line item to clarify that this is the amount of money that is possible to be used to pay out dividends in future years. So yeah, it's really just a line item in the investment trust's accounts. But yes, as you say, it doesn't have to be kept in cash. It is often reinvested in line with the investment trust's strategy, in the same way that the trust earns income during the year, they don't keep it until they pay out dividends at the end of the year. They can reinvest it in their portfolio. So yes, as you say, if the fund does need to draw on their revenue reserves to top up the dividend, it will usually involve the manager selling some investments to realise cash, and then as they pay out that cash as dividends, that will reduce the line item of revenue reserve in the accounts.
So how often are investment trusts paying dividends? Is it typically every 6 months, like as if you'd invested in an individual company? Or, I presume then that there must be examples of trusts that pay more frequently than that.
So it does vary. Some investment trusts don't pay a dividend at all. Some pay annually, some pay semi-annually, some pay quarterly, and a couple even pay monthly dividends. For investment trusts that are specifically focused on paying out income as part of their strategy or objective, then quarterly payments seem to be probably the most common among income funds.
So, I'm just wondering, how can some pay dividends every quarter or every month and others can't? Is it the type of things that they're investing in that they're actually receiving income on a more regular basis then?
So there's no technical or legal reason why an investment trust couldn't pay monthly or quarterly or any other frequency. But the reason that we probably don't see monthly that commonly is because for funds that are aiming to fully or predominantly cover their dividend with income earned during the year, it's more difficult to know kind of in month one what your income is going to be for the full year. And consistency of dividends is also something that these funds look for. So it's difficult to decide what monthly payment to set at the beginning of the year when you don't really have visibility of what the annual income is going to be. So it does depend on kind of what you're investing in, of how often you'll be receiving income. So there's an investment trust called 24 Select Monthly Income. It invests in debt instruments and it will receive income monthly and it can pay out income monthly. So there's no legal reason, and it depends on the preference of the board and the manager and how it suits the investment objective.
Yeah. So some investors will sort of look around for opportunities, and they might select a trust because it's got highest dividend yield. That isn't always the best approach, because actually high dividend yield could be a warning sign. I just wondered if you agreed with that. Get your thoughts on it.
Yes, exactly. So an investment dividend yield is obviously a function of its annual dividend payments divided by its share price. So a high yield can reflect either high dividend payments and or a low share price. And that low share price can be a potential kind of red flag, indicating a number of potential concerns for various different reasons, including an expectation from investors that dividend isn't sustainable and is likely to be cut in the future. So something to look at to assess the sustainability of a high yield would be to look to see if the dividend is fully or mostly covered by earnings, or whether you think that the manager of the trust is struggling to kind of earn the income in order to pay out that high yield.
That was Emma Bird from Winterflood. Last but not least, it's time for our usual deep dive into some of the bigger investment trusts on the market. This week, it's the turn of Ian Conway and Steve Frazer, my colleagues at Shares Magazine, to talk about Monk's investment. Let's hear what they had to say.
It's a big trust. It's a big trust nowadays. It's just short of £3 billion pounds of assets. The Monk's name, though, goes back to the 1920s when it was set up. The there were three of them: monks, friars, and abbots. And they were all called that because the company secretary's office was in Austin Friars in the city. And Baillie Giffo took them over and ran all three of them, actually, until 1968 when they merged. And as a result of that, it's obviously got great long-term performance. But like a lot of growth funds, it struggled when interest rates went up, because those long-duration businesses where, a lot of the values in the future for them, they really struggled in 22, 23. So yes, fantastic long-term performance, but had a bit of a hiccup in 22, 23. Seems to be back on track. Year to August, I believe it's up 20%, which is in line with the FTSE World Total Return Index. So it does seem to have got back on track now.
I mean, it's not only growth, though, is it? I mean, I suppose some of the portfolio, I mean, it seems quite kind of old economy, and companies like CRH are in there, and Reliance Industries, which is a kind of that Indian conglomerate that makes makes all sorts of engineering bits and bobs and so on. So it's not only kind of exciting growth companies.
Well, this is the thing. They do say that their USP is looking to capture unrecognised long-term growth opportunities. And what they do is they call it a wide-angled view of growth. So they look around the world for companies that are good quality, growing, and really importantly, can raise prices. And so bringing us back to CRH and Martin Marietta, building materials, companies have had a fantastic last couple of years being able to raise prices. But you're right, not the kind of stocks you typically find in amongst your Microsofts and your Amazons.
And there's plenty of those in the top 10 holdings as well, isn't there? I mean, Microsoft, you mentioned, that's the biggest stake with about 3.7% of the fund. Amazon, second biggest, sorry, about 3.5%. Meta's there, and TSMC, the big Taiwanese chip manufacturer. Interesting as well that they also do like to invest in unlisted, privately owned companies, but that doesn't mean it's a proxy for Scottish Mortgage, which invests up to 30% of their fund in unlisted. Monks seems to keep their unlisted exposure to this Chilean fund, if that's how you pronounce it. It's about 2.7% of the Monks fund, and my understanding, Ian, is that's also run by Baillie Gifford.
It is, Steve. Yeah, the Schiehallion Fund. And you're right. It's quite a small part of their business, but they do like late-stage private companies. And so top holdings, no surprise, being Baillie Gifford, SpaceX, ByteDance, which owns TikTok.
Yeah.
There's a firm, which is a buy now, pay later firm, like Klarna, which people probably heard of.
Right.
The one that amused me was Bending Spoons, an Italian software company.
That's not run by Uri Geller, is it?
No, and Wise, the payments group.
Right.
So these are all what they call later stage private company. Yeah, this is not venture capital stuff. These are really big established businesses throwing off loads of cash already.
Yeah, and as we know, I mean, the IPO market has been pretty threadbare for 4 or 5 years now. So I guess that there's going to be at some point you'll see some of these privately owned companies go to public markets, but it doesn't sound like there's any kind of rush. I mean, we increasingly hear entrepreneurs being much more comfortable being away from the public sector scrutiny. So it does suggest that some of these companies, perhaps like SpaceX, I can't imagine that Elon Musk is going to be in a massive rush to go and stick that on the NASDAQ exchange.
No, I mean, Klarna, there has been a lot of talk of that going public. And when you look at public valuations, we were just talking this morning about this, about how public markets have raced ahead while private equity valuations have kind of been static over the last year or so. So there is a big gulf between them. And there's a lot of appetite out there for private assets. So who knows? You could see this firm business or even Bending Spoons coming to a market near you soon.
That is a brilliant name, by the way. So let's just move on to its performance. So in terms of the near-term performance, it's done reasonably well. I mean, over the last year, the share price is about 25% to the good. That's against its Investment Association Global benchmark, which runs at about 20.4%. So it's outperformed its benchmark. And net assets have also been, positive. But I suppose over a 3-year time frame, we largely expect it to have underperformed because it does have this kind of growth driver, and it certainly has underperformed over 3 years.
They're a little bit like Fundsmith, actually. They like to show that their companies have a higher average gross margin than the index. The earnings growth is higher than the index. All these kind of tick boxes. The gearing is lower than the index. That was great until interest rates suddenly shot up and everybody went value.
Yeah.
Crazy.
Yeah, absolutely.
But, these companies, over the cycle, these companies are going to do well. And so, as you say, really decent performance over the last 9 months to a year.
I mean, I think one of the things always to look at is to look into some of the companies that are in these investment trusts and in Monk's portfolio and look at how they're performing operationally. That's more difficult, obviously, with unlisted. But with public listed companies, you can see how well they're performing by just looking through their quarterly results or half years, full year results, etc. And it's interesting when I look at a 5-year view at Monk's performance. It's at 32% versus the index of about 31%. Doesn't seem a huge outperformance, and it's not. But look at the NAV performance, and that's about 52%. So that suggests to me that the companies in the portfolio are really operationally performing really well. The fundamentals are there to support it. It's just the share price just simply hasn't caught up.
Yeah, absolutely. And as I say, a lot of funds will find themselves in this situation where the NAV has done really nicely, but shares have just not. The investors seem to have gone straight, into value, bought all the banks, bought all the oils, the miners. That worked really well. That trade, my sense is that trade's unwinding now, and people are looking as interest rates are coming down. They are coming back to these growth companies. So, by rights, we should see discounts narrowing on these growth trusts.
Yeah. Just a final point as we wrap up. Just talk about the discount. I mean, it's interesting. I look at the discount premium high has been a premium of 7%. The discount low has been a 14.7% discount to net asset value. I just wonder, Ian, what do you reckon the discount is now?
Oh, yeah, go on, you got me. I have absolutely no idea. What is it?
So the average is about 4.7%, and yet today it's trading about 10.6% discount.
Really? So it's still quite a lot wider than the average.
Which again seems to suggest that share price performance simply hasn't caught up with what's really going on with its portfolio companies. And as you mentioned earlier, they're high quality businesses, so you don't expect their trading to be affected quite so dramatically by things like interest rates, by things like what's going on in the Middle East, et cetera, et cetera.
So that was Steve Frazer and Ian Conway from Shares Magazine. And that's all we've got time for this week. But before we go, I just wanted to give listeners a little bit of good news about the podcast. We can now call ourselves an award-winning production because the podcast has scooped up a prize at the recent AIC Awards. That's the Association of Investment Companies.
Yeah, big congratulations, Dan. Quite the accolade.
Yeah, so AJ Bell won the Shareholder Engagement Innovator Award for the launch of this investment trust podcast. And I quote, "The judges found the content engaging, enjoyable and informative, and an excellent step forward in bringing investment trusts to the attention of direct investors." So thank you very much for that. The normal edition of the Money Markets podcast will be back later this week. So until then, thank you very much for listening, and we'll catch you next time.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.